Okay, let's get started. Today is Thursday, October 23rd. It's 11:02 a.m. and we welcome you to the Strategy Asset Managers quarterly market outlook call. Uh, we are excited to give you the opinion for the third and fourth quarters, as well as some outlook into 2026. The theme for the call today will be Power in the Future, why the market has room to run. We will also, Joe wanted me to remind everybody that the stock market is not the economy. The stock market is not the economy, and that's also something that we will capture today. We're at the early part of earnings season. We have updates on several companies that we own in the portfolio. Overall, from a market review standpoint, we've had a very good year for the stock market. You've probably experienced that, and also globally. Joe will go into details on that. I don't want to steal any of his thunder. And the outlook, and right after this, I'll turn it over to Joe, is extremely strong. We think that there's a solid period ahead of us for stocks globally, and why we expect corporate earnings and the momentum to power a solid finish to the end of the year. And now I'm going to turn it over to my Chief Investment Officer, Joe Traba, and also Alex Hagstrom, where I will help moderate the talk today. We're looking for the call to end at 11:30. So we've got about 28 minutes, about 25 minutes to go. All right. Go ahead, Joe.
All right, thank you, Tom, and thank you everyone for listening. As always, before we go forward, we like to kind of look backwards and what a year this has been. If any of you remember, it seems like such a long time ago, but just March and April, markets were down 20% and people were nervous about everything. Fast forward, we had a nice rebound, and you look at most global or most even US domestic indices are all making all-time highs. This is a very strong market. You have a lot of momentum that's come, not just domestically, but as Tom mentioned, globally. You have one thing that we like to keep an eye on is you still have governments around the world spending. That's a key element when you have governments spending. There are some negatives to that, and we'll address that shortly with deficits. But it's powerful to see the markets do this well, not just large cap, but it's gone down to the smaller caps as well. And as we had mentioned, Europe, this is the developed markets, and emerging markets are also doing well. When you look a little bit down the road, again, the market, and why we say focus on the stock market, it is not the economy. Earnings are the key driver to the stock market, and they continue to go up. Now, we just started this quarter, and so far what we've seen estimates have gone higher. It's early, but again, that's a good sign. Companies are making money and they are growing. That is what the market always eventually gets back to. Now, there's some key elements that we'll get into that shapes our outlook. And a big part of that is the technological disruptions. Think AI. And we'll go into a couple of really cool items that I want everyone to kind of think about. We'll also go into part of the reasons we're optimistic with global is infrastructure. And again, that's a part of AI. And then we'll look at some of the things we're keeping an eye on. These are what we'll call headwinds. And that is obviously where deficits are at, not just domestically, but globally. We'll look at higher prices and the impact on the consumer. And we'll also talk about global trade, how that is being reshaped. And then we'll leave with why we continue to remain optimistic. Now, one of the big keys that I want to focus in on and why the recovery, again, you typically have a 20% drawdown every 3 to 5 years. You typically have 2 5% pullbacks during the year. last year we had a very low volatile market. This year's, kind of the opposite. We've had a lot of volatility. But one theme that's been consistent is the increase in productivity caused by AI. We also look not necessarily the direct correlation with AI, but we were seeing in order to power AI, you need a tremendous amount of power. And we saw the CapEx that has been happening in the US. Now we're starting to see it go global. And that's a very powerful elixir. And companies that benefit from it are not just technology, but it's the infrastructure. That's industrials, it's utilities. And one of the big things has been nuclear. Now, a lot of people that have been on our calls has heard us talk about this, and we'll continue with it. There's just not enough supply to meet demand. And again, it's anticipated when you do a click on Google or any browser, it takes 10 times the amount of power to do a AI lookup. So that's a tremendous amount of more power onto the system. But you also kind of think one of the great things, and I'll bring Alex onto this, is we looked at the number one job in America or the world is the driver. And what are we seeing transform right now? I always go back to if anyone has not driven a Waymo or autonomous vehicle or driverless vehicle taxi, you should try to get on it. Number one, the safety of it. And it is just tremendous how many less accidents happen. Alex, did you want to? We can.
Alex, you're on mute. Try it again.
As he's going on to that, we were talking about this, and the number one job used to be the farmer in the US. And everyone thought, okay, now that's getting changed and doom and gloom. No, it changes. So there's always going to be cycles that we go through. And just because we're seeing, more autonomous driver doesn't mean that we're going to lose jobs. It just gets transformed. Alex? Nope.
Well, Alex's mic is, we'll have to reboot on him, but we'll just keep going on and talking about that. Why don't you just expand on that, on the autonomous drivers right now?
Yeah, and when we were looking at this, it's when you go through when you're driving, the number one place for an accident is the intersection. And results that they've seen where new autonomous cars are driving, it reduces by 70 to 90% the number of fatalities from driving. And then also the number of big accidents that happen. And you can kind of just anecdotally think of when you're walking and crossing an intersection, you'll see a Waymo driving and then it stops. It wants to make a right turn. And then you'll see the little Coco, which is the little cooler on wheels that is doing deliveries. They're communicating with each other, and one's letting the other one go. And then it slows down and then it accelerates. So just by slowing down, you are also reducing the number of harder or more severe accidents. So again, that's just transforming, it's a simple task that we do that is saving lives. And that's going to be a huge roadmap as it gets rolled out. So that's one big positive. The other big productivity that we've seen is we talk about the effect of the weight loss drugs. We call this the wellness. And part of the wellness is people, when they do get on these drugs, you're no longer as overweight as you were, and that has a lot of positive impacts. But we look at the effect on consumption. And what I mean by that, if you're not, eating as much, you're not buying as much food and your behavior shifts. And that has a dramatic impact on what we look at for spending. And one of the traditional one was alcohol. We call this like the sin stocks. And we've seen a big decrease in consumption of alcohol in the US in particular. Now there's disruptions and there's a suitability that it's transforming into more smokeless tobacco, those types of products. But we are seeing, a change on people's consumption with junk food and again, getting a little bit more less processed food and more fresh food. So these are just some things that I think are continuing, and that's driving how we look at the outlook.
Let's see if
Alex?
Alex's mic works
Yeah,
now. Great.
apologies
Perfect.
about that.
Welcome, Alex.
Yes, my apologies.
So with the impact on AI, did you want to touch on just the automobile car and also
Yeah,
some?
absolutely. Autonomous vehicles going to be an incredible innovation, especially in terms of saving lives. There's about 50,000 people dying each year in America, and maybe like 1 million worldwide. And we can expect autonomous vehicles when that gets fully implemented to basically reduce that near zero. If the entire road system and vehicle system was autonomous, there would probably be almost no deaths. So just one of the greatest innovations that we're going to see over the next few years.
Yeah, and part of what Alex is saying is the infrastructure build out. So when we say that, that's a loose term. You have to roadmap all vehicles and they have to know where everything's going. You have to have, painted lines, you have to have, walls on the side. So it's a big build out with that. And then also with having demand for electricity. So this is kind of a big build out that we're thinking that is going to continue globally. Another part of that is with some of the infrastructure, as we know, living in LA, some of it's over 100 years old. So that has bipartisan support for rebuilding. And it's also transforming how we look at populated areas in our country. Ohio and kind of middle America that were more farmers are now turning into data centers, and it's exploding. Alex, did you want to?
Well, yeah, and I think one of the most positive aspects of that people are not talking about is that in large part it's actually going to be funded by foreign governments and foreign corporations. So as of right now, there's basically 5 trillion of promised investment from, the UAE, Saudi Arabia, foreign corporations. It's likely to go up as trade deals are reached with India, potentially China and Russia. So not only are we going to get trillions of dollars of investment, it's going to be funded from overseas, which is, even more beneficial for the United States.
Alex, you made the point that after World War II, we had the Marshall Act, and then this is kind of the equivalent of the reversal of the Marshall Act.
Yeah, yeah,
It's
absolutely.
it's
Yeah.
important to talk a little bit about that.
It's tremendous, right? And that was, only tens of billions of dollars, and it had a huge impact for Europe. But 5 trillion, it's almost an incomprehensibly large number. I mean, we talk about AI investment being huge, and it is, but that's only $1 trillion. This 5 trillion, it's enough to completely reindustrialize, revitalize, just incredible. And like I said, we might hear tomorrow that India is going to do 500 billion and China is going to do another 500 and Russia. So just incredibly positive for the United States.
And that could also happen globally. I just got back from Dubai and Abu Dhabi, the United Arab Emirates. Those are two very sophisticated major cities, globally now with infrastructure that was reminiscent of what took some cities 20 years to build. It's taken them half the time. So investment is being made outside the U.S., and there's a lot of investment being made in the U.S. right now.
Yeah, and now on that note, you are hearing a lot of spending, but what happens? You have governments having massive, right now, the US national debt, it just topped over 38 trillion with a T. So as we talk about the positive effects, I also want to counter that with what are some of the concerns out there?
Sure.
All headwinds. And again, the US national debt, 38 trillion with a T. And again, as a positive, the government continues to spend. That helps the market. A negative, you have a deficit growing. And again, how do you address that? It's two ways: tax more or you cut spending. And that's what we're going through right now with the government shutdown. That's part of it. These things, as we talk about the government shutdown, this is right now the second longest in our history. But why is the market, not even really paying attention to it? Well, because again, we historically look back at what happens, and these deals will get done. You can look at the betting odds. It's supposed to last, I think, another 15 days. We're over 20 days now. But we do think, cooler heads always prevail, and they will again. And that's a positive there, but it also goes into next week. Next week, our Federal Reserve is meeting, and it's widely expected that interest rates are going to be cut another 25 basis points. So another 1/4%. That goes on to what we saw in September with one rate cut. So the benefits from having a rate cut is obviously in the US, servicing the debt that we just mentioned, that goes down with the amount of interest. But I also like to think of it, how does this affect you or just a family? If you kind of think you're on credit cards, and this is more for people that do not have a lot of assets that are using credit, that has been a major driver for financials as they're able to increase lending and increase how much money the banks are making by the interest that people are charging or paying on their credit cards. So that is a slight reduction. Does help not just the consumer, but companies able to service their debt. This is important because, and I'm going to bring Alex into this, you're starting to hear about bankruptcies. And this is something we didn't really hear about too much during COVID because of all the bailouts that were being done. But now we're starting to hear more and more on some of the bankruptcies. And a few of them affected the auto industry. And I'll let Alex come chime in.
Yeah, I mean, a lot of, fairly sizable bankruptcies in the auto space, most notably Tricolor, First Brands. There's going to be a lot of others, but we're not invested into the automotive industry in any way, in any strategy, so we're not affected by this. And ultimately, the only way to resolve the post-COVID inflation, which has been, incredible. The average new car in America is more than $50,000 now, which is, ridiculous, and it needs to go down. So we will need to see a cycle of bankruptcies. We'll need to see people who can't afford their cars get those cars repossessed. Unfortunate as that is, that's how capitalism works, and that's the only way for the inflation to basically heal. So we don't view that negatively as we're not exposed to the auto sector.
Joe, go ahead, Joe.
It's also, what's the cure for higher prices? Higher prices. And again, it lowers demand because you can't afford as much. So we look at that, it's twofold, and you can look out through history, when this happens. But the big key pin to focus in on is employment. As long as people are employed, working, spending, that can just keep this engine moving. It's when you see companies laying off people and people not spending, that is when things turn negative. And we're just not seeing that right now. Go ahead, Tom.
Joe, talk a little bit about corporate earnings and why they're moving higher. Expectations have been adjusted, and I'd like you to opine on that with Alex.
Yeah, this is really a global phenomenon that we're seeing. We always talk about financials. They don't need to lead the market, but they need to participate. Most global benchmarks are comprised, that's the biggest component. They don't have US technology. US technology has led the last 10 years. The market's higher, our market's higher in particular. And now we're starting to see that transform into some of the global companies as they play catch up. But the big earnings movement is really, again, from the big AI companies and the mega cap companies. But we're seeing financials participate. And kind of think about what we just talked about. Banks are lending, banks are making money on credit cards. Now banks are making money on mergers and acquisitions, and we call this the financial activity. And what you're seeing, it's heating up. You're seeing more mergers and acquisitions. We just had Electronic Arts, which is one of the largest companies for, if you play video games, they're just taken private. And this, we're going to hear more of this. It also has more IPOs coming out. That's initial public offerings. That means, again, there's a demand for new companies, and these private equities are pushing it out. So that's a good for the cycle and good for the financial activity. It helps financials perform better. And again, when they're lending, people are getting access to capital, they're spending, and that helps, the chug of our engine. And it does spread out to retail and everything else. So that's a big positive. That has been a big boom for the United States, and we're seeing that go global.
Joe, talk specifics in earnings season, what we've seen so far from the companies that we own, and then next week we're going to see a few more. Can you just give a couple of examples of um,
Yeah. So the big thing is we talked about, to expect a little bit of a breather for the market, and some of the best performing stocks, like a JP Morgan, is up, 30%. They posted earnings and very good earnings, and it had a little sell-off. So that is to be expected, a little bit getting ahead of itself, and just some profit taking. That's good for the markets. Things that have done very well, you need to see them just have a little bit of selling here, and that money gets shifted into things that aren't doing so well. So we saw that with a lot of the big tech companies and money going into some of the more value names. And one of those was Nestle. Nestle, everyone can kind of think of. We call this more the middle of the aisle consumer products, but that's one that had up 10% after their earnings. Now they did announce they're going to be laying off 16,000 people over the next couple of years, and this is the global workforce. But these are things that we needed to see happen. Again, a lot of companies, with the help of AI, they're beginning reshaped. Another one that we like to talk about is the effects of AI. And one of them in our growth strategy is intuitive surgical. And this is the robotic surgery. It's absolutely fascinating. We have a few clients that are doctors and use it. And the robotics on this, it's just like we said, how we look at autonomous driving. When you look at how procedures are done, having less invasive surgery, your recovery time is so much faster. You're so less likely to get an infection. A lot of good positives that are happening from this. And that's what I think we have to get our head wrapped around, how technology is going to improve our standard of living. That it's quite remarkable when you kind of think of the possibilities. So those are just a few examples that we've seen so far.
Alex, do you want to comment also?
Yeah, also the trend towards electrification, just the overall reindustrialization, which we're, exposed to through various companies, whether they be in the nuclear industry or, robotic manufacturing. Those companies are continuing to post very strong earnings. And this reindustrialization and AI build out, it's flowing through essentially every sector of the economy other than those specific, retail consumer sectors. But anything that involves manufacturing, it's all looking very strong, especially over the longer term.
That's great. Joe, do you want to? We touched on how the stock market was responding to the government shutdown, and earlier the first line that we gave is the stock market is not the economy. It's always very forward looking. Can you comment a little bit on that, please?
Yeah, so again, we're looking at when you have a government shutdown, it does reduce GDP. But again, so you might see short term that get reduced. And you kind of think about it, it's if you want to go to some of the national parks, some of them are closed, and that obviously reduces the amount of spending that would have happened. Um, that's short term. People will go back and it does get picked up again. But again, the stock market, when we talk about earnings, people that are invested in the stock market are tendency to be more affluent, and their houses are doing well. Their 401k, their balances with the stock market being up, they're doing well. They can withstand, higher prices, a little bit better than someone that is making, just getting ends meet. And I think that's the dislocation that we're seeing. We're seeing the subprime lender really get hit by a lot of these higher prices because it's taking more of what they earn away from them. We talked about some of the higher prices to be expected for not just your electricity bill, but all your utility bills have gone up. And insurance, that's gone up. Anyone getting their premiums for homeowners, that's going to be a big increase. But those are fixed costs that people pay. And even if you have Netflix or any subscription on TV, they all raised prices. Disney did as well. So, you're seeing a lot of prices. That just means what you can spend on, you can't spend as much on discretionary. And on that point, we also talk about companies we don't own. And one of them that I think is fascinating is Coca-Cola. And I kind of lump them in with McDonald's. They reported earnings. And when I think of Coca-Cola, I'm kind of old school and I think of the soft drink. But what they're seeing a big earnings increase in, and this is on the energy drinks, and really think of caffeine or anything that's providing the boost. That is a massive increase in consumption in those types of drinks, which kind of coincides with less consumption and lower margins for, the traditional, like a Coca-Cola that you would drink. So, and it's also a shift into more of the diet drinks or zero sugar drinks. So you're seeing companies adapt to the landscape. And again, this wellness component is a big part. And it's, just very simply what you drink, what you eat. And good companies are able to, shift. And I think that's what we're kind of in the middle of right now.
Yeah, Joe and Alex, we talked a little bit about the demand for energy with the consumers and consumption of caffeine, but it's a nice tie into the energy consumption for data centers and energy transfer. We should touch on that, and then I want to go into kind of what we're paying attention to and the headwinds. But and then end on a positive note. Let's try to do it in less than 5 minutes. We're going to go 3 minutes over. Let's try that, okay?
Okay, I'll go first, Alex, on the power. Again, like we talked about, the global consumption is, continuing to increase. Nuclear used to be a dirty word. It's not anymore. And again, that's bipartisan support. We are, definitely involved in that directly and indirectly. But in order to get a new nuclear power up and running, it takes years to get their approval. You have some overseas that are getting more streamlined to get it faster, but it's a bipartisan support and it's also a joint venture with the public and private sector. And that's what you're seeing more and more of as expansion continues throughout the US. The public sector, this is the government working with companies to, have a new land development, but also sponsored by a company where they're going to assume X amount of energy that gets allocated to them. So this is good. This is, how we move forward with that. Alex?
Yeah, we need more natural gas plants and more nuclear plants. And with all this investment, I expect those to be built over the next few years.
Yeah. Talk about the tariffs and the headwinds that we were expecting to see from the tariffs, and now we're probably experiencing some tailwinds. So
Yeah, it's kind of funny how quickly people turn, right? Because I remember all the hysteria and the people saying in April that tariffs would cause a new Great Depression. And, everybody has forgotten about that because we really haven't seen any really significant deterioration as a result of tariffs. And again, and at some level, they've been positive because they've forced these foreign nations to invest trillions of dollars into the United States. So, it certainly has not been the disaster that so many economists predicted.
Joe, any comment?
Yeah, no, I think we've hit on power and infrastructure. But to go into your second point, some of the things that we're looking at or concerned, one of the words that we've heard is cockroach. You don't just see one cockroach, you see many. And part of that, when we look at some of the bankruptcies that are coming out. And I think it's important to know what you own. So some of the smaller banks that we don't own had exposure to these companies and they had giant write-downs. I think you're going to, hear more of that as we get through this cycle. Some of this is fraudulent. Some of it is just a change of consumer spending. But that's one thing that we pay attention to because you'll see dislocations in the financial markets, and then the stock market, will follow when you have sizable disruptions. But again, we've gone from no bankruptcies to starting to see some come out. It's just right now, it's something that we're paying attention to. And the big one is employment. We're still fully employed. And we do think, again, companies are going to lay off people as AI does more becomes more prevalent, but I do think there's other jobs that are getting opening.
So, there's a healthy skepticism that can allow the bull market, to continue to grind higher, specifically into year end. That's important. And if this momentum continues and the hard economic data that we are continuing to see will show on the upside a kind of a conjunction for historical strong performance. Why don't you comment on that and then lead into the M&A and IPO market, Joe?
Yeah, no, we just wanted to keep the call down, so I'll just be quick here because we're already approaching 30 minutes. But our outlook is positive, and I'm not just saying that, what we look at does drive, and that's holding us accountable and how we're invested. We do see the consumer slowing down. That has us less involved in direct retail. We like to see where money's flowing into, and that's the infrastructure, and that's the build out that we spoke about. And we have to remember America has the technology. This is where you get the opportunity with an idea to go global and make as much money as possible. Now, with that, you have to have the other end. When you make bad decisions, you have to be allowed to go bankrupt. And I think that's, just a part of a natural market cycle. So we're going to see that. But again, there's a lot of positives that are coming from this, but there's going to be some negatives as well. And as we power forward, you're seeing some catch up globally, and I think that deserves some allocation as well. Governments are spending, and you're going to have more disruptions overseas that are going to be positive. And I think people get caught up in now in the negatives. Think about when those negatives are resolved, then what do you look at? And that's what Tom was mentioning. The market climbs a wall of worry. There's a healthy dose of pessimism out there right now. And I think once those issues get resolved, then what are people going to be worried about? So look at that as your next generation and also next year's outlook, where what's transpired this year and why that can continue. Now, we mentioned the headwinds, and those things we'll be keeping an eye on as well.
So the M&A and IPO markets are continuing to heat up, and that's usually where the smart money is reacting to what they see ahead. That's a positive trend. And then we are also taking profits in some of the stocks that we've owned since the beginning of the year, but we maintain the domestic cyclicals, and that's including industrials, financials, and communication services. But we want exposure to the pockets of the value out there, and that's energy and healthcare and materials. Think gold and silver. Alex, I'll let you have the final word in that area as well.
Yeah, so I think there's been a lot of talk, given the rise in gold, that it represents some sort of replacement of the dollar in the financial system. That is definitely not true. Most of those articles, showing, how much gold has gone up. It's not a result of foreigners ditching the dollar for gold. It's simply gold appreciating in value. And I think one thing to touch on for a second is stable coins, which are basically transforming the whole financial system. It's a very esoteric topic, but causing trillions of dollars of demand to be created for treasury bills. And the dollar is not losing its status as a reserve currency to gold. That is not something that's happening. There are central banks buying gold, but they are not ditching treasuries. And in fact, foreigners have been buying lots of treasuries this year, even since April.
Yeah. Joe, any final comments, and then we'll sign off?
Yeah, just we always try to, keep people, don't get emotional when you're talking about your finances. It's the same thing with investing. Yes, it's been a whirlwind, and there's always going to be something to worry about. But you have to kind of always look ahead. And I do think there's going to be pockets of strength in this market. And as we look into next year, we wanted to share with you some of our optimism, because again, the pessimism gets more play out there. And again, we want to remind people of the positives that are coming out here. And with technology, this is just a cycle that is unseen since, the dot-com. And some of the fun things that people like to play with, you can now, with a picture, make a movie. And these things are really fun to play with. but you then think of what is it replacing. And I think that drive going forward will make our lives more productive and also healthier. So just keep that in the back of your head as we get into November and Tom making a big old turkey and eating half of it. We do have to have a little bit of awareness of what we're putting in our systems. But again, it's some good things to look forward to as we head into the holiday season.
Yeah, we've got a lot of good things to be grateful for heading into the next couple of months. Monday, just as a shameless plug, 10:30 in the morning, which is our time. I'm going to be back in the studio for CNBC in New York, live on Power Lunch. So it's a 2 p.m. execution time, Eastern time for me. We'll talk about some of the topics that we discussed today on the call. The following week, I'll be back on Fox, which will be nice. We're getting some great exposure because Joe, Alex, and the team are doing such a great job with the portfolio management side of things, and I'm able to get out there and communicate that to you all, and we're very, very grateful for that. So today we will end the call saying have a good holiday season. We'll probably check back in closer to December, but thank you very much for being on the call today. Once again, this is Thursday, October 23rd. The call time is 11:38 p.m. and we're going to be ending the call now. If there are any questions, we will have the call recorded, or the call is being recorded, and we will put that up on our website. And if you would like a transcript for the call today, we'd be happy to forward it to you. Joe's market outlook went out a couple of days ago. We'd be happy to talk to you, and please check in with your financial advisor for additional direction on making good decisions with your money. All right. Thank you very much, everybody.